Okay, let's talk about a big goal. How do you generate something like $50,000 a year just from dividends? Now, we're not just talking about saving up a giant mountain of cash. Today, we're going to dig into a specific strategy called the Trinity portfolio, which looks at this whole problem from a completely different angle. It's the ultimate question, isn't it? The one that probably keeps a lot of us up at night. What's that magic number you need to hit to finally retire and be comfortable? How much is actually enough? For a lot of people, the answer they hear looks something like this. A jaw-dropping $2.5 million. I mean, that's a number so big it can feel completely out of reach, almost like a fantasy. But what if that huge number is based on a shaky assumption? The source material we're looking at today has a pretty bold take on this. It says that 2.5 million is only the reality if you're chasing pathetic 2% yields. Wow, pretty strong words. So let's break down what that means. So if chasing those standard 2% yields is pathetic, then what's the alternative? Well, this is where the Trinity portfolio comes into play. It's a strategy that completely reframes the goal. The focus shifts from just hoarding wealth to actually building an income-generating machine. And here's the entire strategy in one simple visual. It's a 50-30-20 split, and each part has a very distinct job to do. You've got 50% dedicated to stability, 30% for accelerating your high income, and 20% for a serious yield boost. So let's dive into what each of those pieces really is. And this right here is the crucial mindset shift. The idea is that you're not just a saver, collecting acorns for winter. You're more like an engineer. And your job is to construct a machine that's designed to deliver consistent cash flow, month in and month out. All right, let's start with the absolute foundation of this entire portfolio, the stability core. This is the biggest piece of the puzzle, and there's a really good reason for that. So the stability core makes up a full half of the portfolio, and it's all about playing defense. Its primary job is to provide that steady, reliable growth, and most importantly, to protect your capital. This is the sleep well at night part of the whole strategy. So how do you build this defensive base? The source material points to something like the ETF SCHD, which is the Schwab U.S. Dividend Equity ETF. The thinking here is that this fund focuses on high-quality, financially strong companies that are known for their stability and long track record of paying dividends. Okay, now for the fun part, the income accelerators. Now that we've got our defensive base locked in, it's time to add a little bit of firepower to our portfolio. These high-income accelerators, they make up about 30% of the portfolio, and they are all about one thing: generating cash flow. The main tool for this is covered call ETFs. Now, without getting too bogged down in the details, a covered call is basically a strategy that generates income from stocks you already own. You're kind of getting paid while you wait. Now, it's really important to understand that there is a trade-off here. Covered call ETFs, like the examples XYLD and QYLD, they're designed to produce high income, right? But they often do that at the expense of some potential growth. So you're basically trading some of your potential upside for a more consistent paycheck right now. All right, we've got our stable base, we've got our income engine. Now it's time to add the turbocharger, the yield boost. This is the part of the portfolio that's really designed to juice our returns. So the yield boost, this makes up the final 20% of our portfolio, and it's all about maximizing our income potential. The main tool for this job is REITs, or real estate investment trusts. These are companies that own and operate income-producing real estate, and by law, they have to pay out most of that income to shareholders as dividends. The goal here is pretty simple: supercharge our dividend output. The source material points to high-yield REITs like Two Harbors and Orchid Island as examples. But, and this is super crucial to remember, these are higher risk, higher reward plays. And that's exactly why they only make up 20% of the portfolio. So we have our three pillars: stability, income, and yield. The big question is, how do they all work together? This slide just lays it all out so perfectly. You've got your 50% foundation for safety, your 30% income engine for that cash flow, and your 20% high-yield fuel for performance. It's a really beautifully balanced approach where each part plays a very specific and very important role. And that really is the key insight. The magic of the Trinity portfolio isn't in any single one of its parts, but in how they all work together. It's a carefully crafted blend of defense, offense, and special teams, all working in concert to achieve that one single goal: consistent, high-yield income. So I guess the final question is this: could a three-pillar approach like this one really be the key to building an income stream that totally changes the retirement equation? Or are the trade-offs, in growth and in risk more than they appear on the surface? That's definitely something to think about.